operation. There are some technicalities when presenting cash flow statements. So one technical issues we need to consider is for the interest payment and interest received. Normally, interest paid and interest received are presented as part of operating activities. However, there are instances when interest paid is being presented as part of financing activities because we can present it as an alternative presentation. For interest received, we can present it as part of investing activities as an alternative presentation. The rationale behind that is that um, interest paid may be classified as financing cash flow because it is a cost of obtaining financial resources, while interest received may be classified as investing cash flow because it is merely a return on investment. Sometimes there are very rare cases when interest paid is being presented as part of investing activity. We present it only when there is a capitalized cost related to a qualifying asset. So that is per IAS 23 borrowing cost and in accordance with IAS 7 paragraph 16. So we also have accounting technicalities regarding to dividends. So normally the dividends received is part of the operating activities because it enters into determination of the net income, while the dividends paid is part of the financing activities because it is a cost of obtaining financial resources. So that is per IAS 7 paragraph 33 and paragraph 34. There are instances when dividends received can be presented as part of investing activities because it is a return on investment. So we can consider it that as well. Also, dividends paid can be presented as part of operating activities because there are stakeholders that request that dividends paid should be part of operating activities in order to know if the cash generated from operating activities is enough for the dividends paid for the stockholders. For income taxes, normally income taxes paid and income tax refund are presented as part of operating activities. However, there are instances when the income tax paid and income tax refund are specifically identified to investing activities, then we must present it as part of investing activities. Also, if it is specifically identified as part of financing activities, then we must present it as part of financing activities. So we all know that income taxes paid and income taxes refund generally can fall into these three operating activities. So in summary, operating activities, investing activities, and financing activities are part of the cash flow statement. So we need to understand more of these activities. So for the operating activities, it is within the principal revenue producing activities of the entity, the transactions within the operating cycle of the entity. For the investing activities, it involves acquisitions and disposals of long-term assets, which is PPE and intangibles. It also involves acquisitions and disposal of other investments that do not qualify as cash equivalent. For financing activities, we must consider the transactions between the entity and the owners, which is equity financing, and then transactions between the entity and long-term creditors, which is debt financing. For the disclosure requirement, any non-cash financing and investing transactions shall be disclosed elsewhere, either in the notes to financial statements or in a separate schedule. So here is an example that we need to identify which cash flow activity are these line items coming from. So we need also to identify if it's a an addition or subtraction to the cash flow statement. XYZ Incorporated had the following cash flows during the current year. One is cash receipts from customers. So we need to identify, is it an operating activity, financing activity, or investing activity? And then is it an addition or is it a subtraction? So number one is a operating activity, but addition. Cash receipts from issuance of ordinary share is financing activity. Cash payments for taxes is operating activity. Cash payments for purchases of inventories is operating activity. Cash payments to purchase major equipment is operating, financing, or investing. This is investing because it relates to equipment. Proceeds from sale of fully depreciated machinery is also investing activity. Cash payment for employees' wages and salaries, operating activity. Cash payments for insurance, operating activity. Cash payments from bank borrowings, financing activity. Cash payments for dividends is financing activity. Cash receipts from dividends on long-term investments is operating activity. And then cash payments for financial assistance to employees due to community lockdown or quarantine, operating activity. Format of statement of cash flow. So we present cash flow statement by two methods. So it's a preference of the company in either to present cash flow, either direct method or indirect method. Under direct method, we present uh, the cash flow statement using the gross cash flows method. So we have cash flows from operations, we have cash flows from investing, and cash flows from financing. These three cash flows, gross cash flows, results to net cash inflows or outflows, on which we add it to the cash balance beginning. Then we get the cash balance ending. Under indirect method, it bridges the net income up to the cash flows from operations. So from net income before tax, we add or deduct non-cash transactions. So examples of non-cash transactions are depreciation expenses, amortization expenses. We also have depletion. We have loss on sale, gain on sale, any other non-cash transaction that affects the net income. Also, we also need to consider the addition or reduction on increases or decreases in working capital items such as increase or decrease in accounts receivable, increase or decrease in accounts payable. We also need to consider the addition or reduction of income tax refund or income tax payment. Then we also need to consider interest payment. So we get cash flows from operation. So we have to add also the cash flows from investing and then cash flows from financing to get the net cash inflows. And then we have to add again the cash balance at the beginning to get or to have it reconciled with the cash balance ending. So key points to consider on the methods used under direct method and indirect method. So under direct method, we are using gross cash flows in operating activities. While indirect method, we are preparing through adjusting profit and loss to compute or derive through operating cash flows. For financing and investing cash flows, they are both presented as gross, either direct method or indirect method. Then we also need to present reconciliation of beginning and ending cash balances as previously discussed, on which we have the net cash inflows Then we have to add the cash balance beginning, then we get the cash balance ending. Then we also need to disclose the cash structure, the component of the cash at the end of the year. So it must also reconcile it with the ending cash balance in the cash flow statement. So presentation and disclosure on the statement of cash flows. So it must be based on the prescribed presentation of IAS 1, presentation of financial statement, because IAS 1 is mainly the accounting standard which prescribe the presentation or proper presentation of the financial statement, on which cash flow statement is one of the sets of financial statement. It must also based on the prescribed presentation and disclosure format of IAS 7 statement of cash flows, on which we need to check the movement of cash and cash equivalent. And then we need to disclose the requirements on capitalized cost based on IAS 23, borrowing costs, and IAS 7, paragraph 16 as part of investing activity. Presentation requirements on expenditures relating to internally generated intangible asset as per IAS 38, intangible assets, which is being presented as part of investing activity. We also need to check the presentation requirements on expenditure on exploration or evaluation activities in accordance with IFRS 6, exploration for and evaluation of mineral resources, on which we present it as part of investing activity as well. For the disclosure of non-cash transaction, as per IAS 7, paragraph 43, we must also disclose, like for example, issuance of shares in exchange of shares in another entity on which there is no cash transactions involved. Also, the acquisition of property, plant, and equipment under finance lease if it's a pure finance lease transaction and there is no cash involved. We also need to disclose foreign currency exchange differences in accordance with IAS 21, the effects of changes in foreign currency rates. So one example I will present to you is this format, sample format. So we have